Welcome back to my channel Teachnology. Today we'll be learning about value, price and wealth in the chapter Basic Concepts of Economics. So let's begin by understanding the meaning of value and price. Value is the usefulness of any product to a customer. It can never be determined in terms of money and it varies from customer to customer. And the estimation of value is based on customer's opinion. For example, if you are going to a gym by spending $1,000 a month, the output seen is worth the expense. Then it is the value that you create for a gym regarding the service being offered there. Here, the worth is its value. Whereas, on the other hand, price is the amount of money paid by the buyer to the seller in exchange for any product and services. The amount charged by the seller for a product is known as its price, which includes cost and profit margin. For example, if you go to a mobile store and buy a phone for Rs 15,000, then it is the price of the product. Let me explain you the difference between value and price with the help of an example, which includes a mother, a father, and a small child. Here, we saw the conversation between the parents where water is much important for us to survive, still it is of low price, while the diamond is just used for ornamentation and nobody dies without it. It is still priced very high. The reason behind this is its value, as the value of water is much for us. It is available at a lower price while the value of diamond is less for us. We now move on to our next subtopic, wealth. Wealth is the abundance of valuable financial assets or physical possessions, which can be converted into a form that can be used for transactions. Wealth is the accumulation of scarce resources. Specific people, organizations, and nations are said to be wealthy when they are able to accumulate many valuable resources or goods. Net worth is the most common measure of wealth. It is the current value of one's assets less liabilities. Anything to be considered wealth should possess the following characteristics. It must possess utility, that is, it must have the power to satisfy a want. As Marshall says, they must be desirable. The second one is scarcity. It must be limited in supply. For example, air, sunshine are all essential for life. In fact, man cannot live without them. They possess great utility, but they are not considered wealth because they are available in large quantities. Their supply is not limited. In other words, there is no scarcity of those goods. Such goods are known as free goods. Then we have transferability. That is, it must be possible for us to transfer the ownership of such economic goods which form wealth from one person to another. For example, take a house. House is wealth, for it has money value. If I pay some money to you and buy it, I can transfer the ownership rights of house in my name. Then we have externality. For example, the goodwill of a business is external wealth. Certain firms enjoy a lot of goodwill of the customers. The copyright of a book is another example of the point that wealth is external. We will now move on to the classification of wealth. Wealth is classified into individual wealth, social wealth, national wealth, and international wealth. Individual wealth is also known as personal wealth. The wealth of a person consists of both material and non-material goods. Thus, the wealth of the person includes material things like land, houses, furniture, machinery, and so on. Not only that, if a person has some shares in companies or bonds which require others to pay money to him, they should be included in his personal wealth. On the other hand, if he owes some debt to others, it should be regarded as negative wealth and so subtracted from his gross wealth. Then we get the net wealth of a person. Then social wealth. It is also called as collective wealth. Social wealth consists of all these goods that can be enjoyed by all members of the society. Social wealth includes public roads, public parks, public schools, government hospitals, and so on. In short, it includes all kinds of public property and ownership. Most of these things are called collective goods, that is, goods that are not in private ownership. National wealth refers to the total value of wealth possessed by the citizens of a nation at a specific point in time. It is the total value of wealth and goods generated by all economic activity in a given nation. The national wealth is a useful framework through which to measure the progress of an economy and corresponding economic resources. It has a major impact on a nation's capacity to generate income. Then there are three factors that contribute to national wealth. The first one is natural capital. It is calculated as the sum of the stock value of renewable and non-renewable resources. Then produced assets. It represents the sum of value of a country's stock of machinery and equipments, structures and urban land. Then human resources. They consist of raw labor that is determined mainly by the number of people in a country's labor force, human capital and an important element known as social capital. And then we have international wealth. Wealth owned by several countries is called as international wealth. World Health Organization, International Monetary Fund, World Bank are all examples of international wealth. Thank you for watching my video. Please like, share and subscribe my channel Teachnology.